ever since they came out, these two funds, HDIF and HDIV, have been confusing me. So I thought to myself, if they confuse me, there must be a lot of other people that are being confused by these two popular covered call ETFs. So I thought to myself, how about I make a video to make that confusion comes to an end, right? And that's why I make this video. By the end of this video, you'll be able to tell which is which. We'll talk about their fund, their fees, their structures, their performance, and all those good stuff. And by the end of the video also, you'll be able to know which fund is suitable for you to invest your money. So let's start. So these are the two funds that we're going to compare today. And the first thing we're going to notice here is the HDIV. HDIV is Hamilton managed or is provided by Hamilton ETF. And HDIF is provided by Harvest Portfolio Group. They're both Canadian companies, so that's the first thing to notice. And then the ticker symbol, of course, one has F in end and the other one has V in the end. Both trade at Toronto Stock Exchange. Let's go to we go to fund objective first. That's the first thing we can objective. By the way, I mean I've talked about these both funds already before, so you can watch my other videos. Check link below. I already mentioned these funds, and but this is just comparison between the two. So fund objective of the F1, it's a Harvest Diversified Monthly Income ETF, offer portfolio of equity weighted Harvest ETF position to deliver a steady monthly income. The multi-sector portfolio is comprised of large global diversified companies. You see the difference here is a global diversified companies, which includes all the sectors in healthcare, global brand, technology, utility, and US banks. I mean, pretty much not all sectors, but a lot of sectors. The ETF is designed to provide consistent monthly income with a growth. A portfolio is rebalanced quarterly, and to generate that enhanced income, they use 33% of the underlying stocks to write cover call on them. So I mean, that's one of the strategies they use. And when you come to objective of this guy, the fund seek to provide attractive monthly income. They both, of course, to support monthly income with the growth, right, with the capital appreciation, of course. But this one is more focused on Canadian. It also has multi-sector portfolio of primarily covered call ETF focused on Canada. This one is also cover call but focused in the US. That's the two key difference between these two first. So you might say it's an not an apple to apple, but then I mean it's an apple and an orange. But this is the whole point of me comparing between the two, and you decide which one is the best for you to invest your money. When you look at the benefit, what would you invest in this fund? So one benefit is to have diversify of your one portfolio in just one stop rather than having too many portfolio. Access to largest companies diversify across sectors and geography, exposure to a powerful long-term growth and trend, consistent income of 850% target. That's their target, but this moment, of course, is 10/10 because the fund has tanked a little bit, and then the yield, of course, rises. They do leverage of course 1.25, so it's pretty much 25% of they do leverage, same as this one. So when it comes to leverage, they both does the same thing. Covered call strategy to enhance income potential and lower volatility. And as we've talked before, whenever they do covered call, usually covered call strategy lowers the volatility as compared to other indexes, right? Zero management fee, subject to fee of the underlying ETF. So this, let's not get carried on this one. This is more of the fund itself does not have a fee, but underlying ETFs that they invest in, because remember, this is fund of funds, does have management fees, and I'll show you how much fee it is. I mean, I've already done the calculation. I've done that for you. So stick to end of this video, you'll see exactly how much you're gonna pay on fees. And then why would you want to invest in this one? Who is a good fit for this one? Of course, is you want a monthly income. Do you want to have this composure to S&P 500, the TSX 60 with the yield? Because TSX, we know it does not pay as much yield, but with this one, you have the same exposure, but you get a high yield, right? Increase growth potential right? Rather than versus individual covered call. And of course, a higher yielding alternative to index that we have at TSX. So that's objective. So objective pretty much they're the same when you are looking for, this is fit for this type of investor. And the only reason you invest is for your money to grow and to get the passive income. That's the main reason for any person who is investing in these two funds. When we let's go to ETF fact sheet, and we'll look here. HDIF has HDIF. That's the ticker symbol, and is Canada hedged underlying, because the underlying ETF, of course, there are some US companies and international companies. So because of the exchange rate, they were going to yield to hedge your Canadian dollars, so you don't have the effective of exchange rate. And of course, they hold 6 underlying ETFs. Management style is covered call ETF, eligible on all the RSP, TFSA, and all those stuff accounts they can invest. This, I can tell you, is basically the same as this one. Of course, the only difference, of course, this one here is Canadian, so there's no really need for that hedge that they do on here. When we look at let's go look at the asset under management. This one has 283 million right now. When it comes to this one here, it's a little bit more at this moment. We'll see here. Look at the asset under management is 310. Yield, of course, is 985 at this moment, where versus here yield right now is about 10%. Distribution is monthly, and this one also does contribute monthly, and risk is medium, same as this one. Risk is medium. The other key factor when we come to let's look at underlying ETFs. So this one has these covered call ETFs. Both of them, they are fund of funds. So they're funds that invest under other funds. So that's what we call fund of funds. This one has about 1, 2, 3, 4, 5, 6, 7, 8 ETFs. And this one has 6 holding. We can see at the portfolio here. If we look at the portfolio, we can see these are the one they invest in. HDIF as Harvest Healthcare Leader Income, Harvest US Bank, Harvest Canadian Equity Income Leaders, Harvest Equal Weight Global Utility, Harvest Tech Achiever and Growth. When we look at this one, also has Harvest Brand Leader Plus Income of different companies as cash and other assets. Cash and other assets, you see minus, because of course it does utilize the 25% of leverage. When it comes to this one, has energy giant Hamilton Enhanced Canadian Financial, and there is Horizon Global Producer. So this one has gold. This one doesn't have gold. It has BMO covered call ETF utility 13% versus, and this one also has utility at about pretty much not the same, but it has a little bit of utility here. Canadian equity, one of these funds, they have utility in, for example, this Canadian one. Except the only thing, of course, doesn't have is a gold here. It has Hamilton. By the way, the HMAX that we've talked about is just been added to this one. This is Canadian Hamilton Canadian Financial Yield Maximizer. This fund just came out recently and is been added into this ETF. So it's pretty good. So they all pretty much diversify across a lot of things. Yeah, you can see here utility is about 13%, and here utility is 13%. Financial is 33, this one is 31. Where it does have more weight than this one is technology. We have 23, technology here is only 10%. And you see the effect of that when we come to performance, when we compare between the performance of these two funds. Gold is 14. They have a lot of gold, right? We see here there's no gold at all. Energy is 16%. When we look at this one here, we have energy at only 9%. And of course, out of this fund here, we can see they are global, as we've seen, and I've said that before. They have a lot of global companies as well, US, and also some of the international company, versus here we only have mainly Canadian ETFs and Canadian companies. Yeah, so when you look at the performance, this performance here, of course, they say it does outperform the S&P TSX 60, which is Canadian market, when 11. If we look at the July 2021 up to now, has it outperformed by 11% versus TSX is only 6%. When we look at this one here, we're going to look at other performance of this fund, and we will see. So these are the main key factor between these two funds here. So let's go to our performance. First of all, if we look at the performance, this is just performance of very short period between the two times, between the 2021, end of 2021 to now. So it's pretty much about a 2-year period. This HDIV has outperformed HDIF. HDIV has outperformed HDIF by about 1 percentage point. Look at this right now is down 6%, and this one has about 4%. So, and you can see this is the V1 and this is F1, right? So the V1, which is Canadian forecast, has outperformed the international forecast. And we're going to see the reason here. I can just tell you the reason. The reason is because if you look at here, we look at technology. We all know that technology has been really laggard recently, right? Look at the technology here. It's about 10% technology, right? This one is 22. So this has a lot of weight in technology companies, and technology right now, we know they are really, really down. And that's one of the reasons why this has underperformed. And also this has gold. So the gold has shielded it from going down and get that yield, that higher yield. And that's the reason why this has underperformed. When we look at our chart now, let's go to our chart and see, this is a scorecard we always do, and see who is the winner. We have to do this. I know it's really hard to do, but we have to do it. End of the day, we have to get the winner. So who wins at this? When you look at the risk, they're all medium, so that's a draw. When you look at the fees, remember that one he says is 0 fee, but of course the underlying fees. So I did math, I did calculation between the two, all of them. Combined, the fee you would pay about 73%. That's a management fee, where HDIV has about 65%. 0.65%, right? That's a percentage point. Let's do this. When you come to diversification, of course, this is Canada and global, and this is only Canada only. So that means HDIV it's the winner here. When you come to performance, this one is actually negative because of that portfolio of a lot of tech stocks, and stock have been performing poorly. And that's what we have. This HDIV has outperformed, and that's the winner right now. When we come to yield, of course, HDIF has more yield, so about over 10%. This one has closer to that, but it's still lower. So we give the edge to HDIF. When you come to size of the fund itself, because this also, it's a good thing to have. The bigger the fund, you have more money, the more people. It shows the more people trust, and the more you can do a lot with your fund, right? And so the fund has HDIV is a winner for that. So all in all, there are 6 categories that I constructed, and out of those 6, we'll get HDIF has only scored 2.6 out of 6, and HDIV has gotten 3.5 out of 6, and the winner at this point, we get H2 HDIV. This is a really a hard call, because one is more focused on Canadian, and the other is more focused on Canada plus international. So in the long run, if the tech company would actually come back to where they are heading right now, I think HDIF will outperform HDIV. I think. But at this point, during this time I'm making this video, right now we have the winner is HDIV, but this is not going to be saying for God, we will revisit this. So just make sure you follow, and I'm going to compare more funds. And if you have any suggestion of what fund you want me to compare, just make sure you leave a comment below and mention those funds I'll compare. And if it's your first time and if you like my content, please like, share, subscribe, and that's it for today. Thank you for watching. Till we meet again. Bye bye.